Cryptocurrency trading has emerged as a popular investment option in recent years, and the market has grown significantly with the rise of new cryptocurrencies and the increasing demand from investors. As with any financial market, successful crypto trading requires a well-planned and executed strategy. The dynamic nature of the cryptocurrency market demands traders to be aware of the risks involved and be adaptable to changes in the market. Trading strategies can help traders to achieve their investment goals, manage their risks, and make informed decisions when buying and selling cryptocurrencies. There are several crypto trading strategies available, ranging from the basic buy and hold strategy to more complex ones such as technical analysis and algorithmic trading. Each strategy has its strengths and weaknesses, and traders should choose a strategy that best aligns with their risk tolerance, investment goals, and market analysis skills. With proper research and experience, traders can help develop and fine-tune their strategies to succeed in the highly volatile cryptocurrency market. Remember that a sound cryptocurrency trading strategy can make the difference between profitable and unsuccessful trades. Welcome to our channel, where we show you all the latest, relevant, and any information that has to do or affects the world of cryptocurrencies, all in the comfort of your very own crypto addict. Today, we'll look into one of the many methods that crypto traders use to make sure that they stay atop of the very volatile markets: crypto tax loss harvesting. Before anything else though, please remember that this video is not any form of financial advice but solely our fact-based opinion that is meant to educate and inform you of the latest and most relevant information fresh from the world of cryptocurrencies. We strongly urge you to do your own research before dealing, trading, or buying any cryptocurrencies. We also encourage you to seek professional financial advice before making any investment decisions and to only invest what you can afford to lose. Lastly, we are not responsible for any losses or damages that may occur as a result of actions taken based on the information provided on our channel. Please use your discretion and invest wisely, because knowledge is your greatest asset. Invest in it first. Let's get to it. So, what is crypto tax loss harvesting? Crypto tax loss harvesting is a strategy that allows investors to minimize their tax liabilities by offsetting capital gains with capital losses from cryptocurrency investments. When an investor sells a cryptocurrency for less than what they paid for it, they can use the resulting capital loss to offset capital gains from other investments or to reduce their taxable income. Tax loss harvesting can be an effective way to reduce tax liabilities and improve investment returns, but it also requires careful planning and execution. In addition to reducing tax liabilities, crypto tax loss harvesting can also improve overall investment performance by reducing the impact of losses on a portfolio. By offsetting losses with gains, investors can effectively reduce their risk exposure and increase the potential for future gains. However, it's important to understand that potential risks associated with crypto investments, including volatility and regulatory uncertainty. Crypto tax loss harvesting is a valuable tool for investors looking to minimize their tax liabilities and optimize their investment returns. With careful planning and execution, investors can effectively leverage this strategy to improve their financial outcomes and achieve their long-term investment goals. Here is a step-by-step guide on how your standard crypto tax loss harvesting works. Review your cryptocurrency holdings. Start by reviewing your cryptocurrency holdings to identify any assets that have lost value since you acquired them. This will help you to determine which assets to sell in order to realize a capital loss. Calculate your capital losses. Once you have identified the cryptocurrency assets to sell, calculate the amount of capital losses you will realize from the sale. You can do this by subtracting the sale price from the purchase price. Offset capital gains. Next, you can use the capital losses to offset any capital gains you have realized from other investments. This can help to reduce your tax liabilities by reducing your overall taxable income. Follow the wash sale rule. In order to avoid triggering the wash sale rule, you must wait at least 30 days before repurchasing the same cryptocurrency asset. This rule disallows losses from the sale of an asset if it is repurchased within 30 days. Consider tax implications. It's important to understand the tax implications of crypto tax loss harvesting. Speak to a tax professional or use tax software to ensure that you are accurately calculating your tax liabilities and taking advantage of all available tax deductions. Monitor your investments. Finally, continue to monitor your cryptocurrency investments and make adjustments as needed. Tax loss harvesting is a valuable strategy, but it's important to balance it with other investment goals and strategies. Before going on with the video, did you expect for crypto trading to have these many factors to consider? Tell us in the comment section your initial impression on what crypto trading is. Now, back to our topic. Like all other strategies, there are some risks to this strategy as well. When considering tax loss harvesting in crypto, it is important to be aware of the difference between short-term and long-term capital gains taxes. Short-term capital gains are taxed at a higher rate than long-term capital gains, meaning that if you harvest losses from assets with short-term capital gains, you may end up paying more in taxes than if you had harvested losses from assets with long-term capital gains. Therefore, when deciding which assets to harvest losses from, it is beneficial to consider their associated taxation rates and to make sure that you are getting the most out of your tax savings by selecting those with lower rates. One risk associated with crypto tax loss harvesting is the wash sale rule. This rule, which applies to both traditional and crypto investments, prohibits investors from realizing losses on a security if they purchase substantially identical securities within 30 days before or after the sale. Essentially, it prevents investors from selling an asset at a loss in order to take advantage of the tax benefits and then quickly buying back that same asset. Investors should be aware of this regulation when planning their tax loss harvesting strategies in order to avoid any potential pitfalls. When it comes to tax loss harvesting in crypto, it is essential to ensure that all losses are accurately reported. This is because any misreported losses can potentially result in hefty penalties. To prevent this from happening, traders should keep meticulous records of their trades and make sure that they report their trades and losses correctly on their taxes. Additionally, if a trader believes that they have made a mistake when filing their taxes pertaining to their crypto trading activities, they should immediately contact the IRS so the issue can be resolved without incurring any additional penalties or fees. Learning about all this might have made you wonder if tax loss is the only way to reduce crypto tax bills. Well, we're happy to answer that one for you too. The short answer is no. And by following these steps and staying informed about changes to tax laws, you can effectively lower your crypto tax bill and improve your investment returns. Use tax loss harvesting. As mentioned earlier, tax loss harvesting is a strategy that allows you to offset capital gains with capital losses from cryptocurrency investments. By selling cryptocurrency assets that have lost value, you can realize capital losses that can be used to reduce your tax liabilities. Hold for longer than a year. If you hold your cryptocurrency investments for longer than a year, you may qualify for long-term capital gains tax rates, which are typically lower than short-term capital gains tax rates. Donate cryptocurrency. Donating cryptocurrency to a qualified charitable organization can also help to lower your tax bill. By donating your cryptocurrency, you can avoid capital gains taxes on the appreciation of the asset and may be able to deduct the value of the donation on your taxes. Seek professional tax advice. Tax laws surrounding cryptocurrency investments are complex and constantly evolving. It's important to seek the advice of a qualified tax professional who can help you navigate the tax implications of your investments and take advantage of all available tax deductions. To report crypto losses on your taxes, you will need to file IRS Form 8949 and Schedule D along with your tax return. Start by listing all of your cryptocurrency transactions for the tax year, including the dates of purchase and sale, the amounts bought and sold, and the resulting gains or losses. Then, calculate the total capital losses from your cryptocurrency investments and use them to offset capital gains from other investments. If your losses exceed your gains, you may be able to use up to $3,000 of the losses to offset ordinary income. Be sure to keep accurate records of your cryptocurrency transactions and consult with a tax professional if you have any questions. Although lowering one's crypto tax burden is a crucial factor to take into account, it shouldn't be the only thing investors concentrate on when purchasing crypto assets, given that tax regulations relating to cryptocurrencies are still developing and can be difficult to comprehend. However, engaging in illicit acts like tax evasion or money laundering to lower one's crypto tax bill may result in legal problems and punitive measures. That's all for today. Make sure to subscribe to our channel so you won't miss out on any of our next videos.